If you have inherited an IRA from a non-spouse, such as a parent, in the last few years, since 2020, then you'll want to watch this video as I'm going to discuss some major changes that have finally been finalized from the IRS that detail how much of your IRA you need to be taking out on an annual basis. Welcome back. This is episode 215. In this week's episode, I'm going to break down the finalized regulations that were issued by the IRS in this past July, on July 18th, for people who inherited IRAs after the year 2020. And I've spoken about this in past episodes. In fact, I have two episodes that I've covered this over the last couple years. One is episode 180, the other is episode 200. However, the IRS has finally cleared up a lot of questions that were still unanswered. So you want to listen to this episode if you inherited an IRA from a spouse, parent, sibling, or friend who died in 2020 or later. I've been getting a lot of great feedback on my book that I published as well in May, and I want to thank those of you that have purchased a copy. If you're not familiar with my book is called Fiduciary: How to Find, Hire, and Establish an Aligned and Trusted Partnership with a Fee-Only Financial Advisor. So if you're in the market for a financial advisor, or if you're working with an advisor and you're wondering if they truly have your best interest at heart, then consider checking out a copy of my book. You can learn more by heading over to retirewithryan.com/book. So if you've been listening to this podcast for a while, you're probably familiar with me talking about the Secure Act. That stands for Setting Every Community Up for Retirement. And it was passed in December of 2019, and it went into effect in 2020. And it brought major changes to many things, retirement, as well as changes to the treatment of distributions of qualified retirement accounts for people that inherit retirement accounts passing away in 2020 or later. And one of the biggest changes was the elimination of what is known as the stretch IRA for non-spousal beneficiaries. So prior to the passage of the Secure Act, if you had inherited an IRA from a non-spousal beneficiary, let's say your parent passed away, they left you their IRA, their 401k, you would then have the option to choose two distribution options. You could either take the account out and empty it out within 5 years, or you had to start taking distributions out by the end of the following year, and you would take those distributions out based on your life expectancy. So the IRS has a chart that you would refer to, and based off how old you were the year that your parent passed away, any non-spouse, you would then take out a distribution. So you could take out the distributions and stretch them over your lifetime. Well, when the Secure Act was passed, it effectively eliminated this ability for non-spousal beneficiaries to do this so-called stretch distribution option. And it really put what everyone thought was into a 10-year bucket for non-spousal beneficiaries. So everyone thought, okay, there's a 10-year window, and you would then have to totally empty out that retirement account by the end of the 10th year following that person's death. So most people are working under that assumption. And so how that would benefit you is that, let's say you inherit this account this year, but you're planning to retire in 3 years. Well, maybe you don't want to take out distributions for the first 3 years because you're still working, but then when you're retired, you could decide to take out distributions in the years where you're retired. So people thought that gave them the tax flexibility to choose when those distributions would be taken out, as long as by the end of the 10th year, the account was fully emptied. If it wasn't fully emptied by the end of the 10th year, then there's a tax penalty that you'd have to pay on top of any taxes. So that's how most people thought that this would work. However, the IRS then released proposed regulations in 2022 that made it seem this was not the case. And I talked about this in episode 200, and I'll put a link to that in the show notes. Again, this is episode 215. If you go to retirewithryan.com/podcast/215, you can get the link to those episodes, or if you're watching this on YouTube, they're in the notes below. So the IRS essentially, due to this proposed regulations, made it seem that was not the case, and that you would actually have to start taking out distributions the year following the person's death, the account owner's death. So this got a lot of people worried, and there was a lot of different opinions out there. Some people were saying that, well, you should start taking distributions out now because that way you don't want to be subject to a penalty. Other people were saying that you had to wait. So we do know now, as a result of this regulation that was just released in July, that the IRS has said you do have to take out distributions every year following the owner's death if the original owner passed away after they had to start taking out distributions. So if they had reached their required age of distribution. So to further confuse everyone, before the Secure Act, that was 70 and a half. Then the Secure Act passed, and that became 72. Then with the Secure Act 2.0 in 2022, it became 73. So again, there's a lot of confusion about this. And the key thing here is that knowing whether when you inherit an IRA from a non-spouse, that's really what we're focusing on in this video and this podcast, is that for a non-spouse, you have to take out distributions the next year if the original account owner passed away after the age of required distribution for them. If they passed away before the age of required distribution, then you have a few different options. So just to really clarify this, I have a chart here that I think is really going to be helpful for you to understand how this works. So we'll focus first on the designated beneficiary. So if you're listening, you could head over to retirewithryan.com and you could get a link to the video where you can see the chart that I'm showing here. So we have designated beneficiaries is the first thing we're going to focus on. So designated beneficiaries fall into one of two categories. So we have eligible designated beneficiaries, and that would be a surviving spouse, disabled persons, chronically ill individuals, persons less than 10 years younger than the decedent. Who would that be? That would be like if you inherited an IRA from your brother, from your sister, from a friend who's within 10 years your age, any minor children, so anyone under the age of 21, and certain trusts that are known as see-through trusts benefiting any of the above people. In this case, again, as I said before, if the original owner died prior to the required beginning date of distribution, then you have two choices. You could either take out distributions over your lifetime using the former stretch rule, or you could decide to take out the distributions over a 10-year period. So in that case, you have different options. If the person died after the required beginning date, then you have to take out distributions over the longer of your life expectancy or the beneficiary's life. So in that case, what does that mean? Well, if you're younger than the beneficiary, then you can take out distributions over your life expectancy. If you're older than the beneficiary, then you would take out distributions over, or I should say, if you're older than the owner, then you would take out distributions over the owner's life expectancy. Then the next group we have here is non-eligible designated beneficiaries. These would be most non-spouse beneficiaries. So an example, as I said earlier, a child, right, a friend, a family member. If you were more than 10 years in age difference from that person, then you would also fall into this category. So you inherit your father or your mother's IRA, then you fall into this group. So in this case, if the original owner died before the required beginning date, then the 10-year rule applies. And in that case, you do have the option to not take out distributions before the 10 years. So you could wait as long as you want within that 10-year window. If you want to wait to the last year, the last couple of years, you can decide to take out those distributions at that point. But if the original owner died on or after the required beginning date, then you do have to start taking out distributions beginning the year following their death. And you would also use the same strategy or refer to the same chart that I mentioned earlier. So this chart is known as the single life expectancy chart. And let's just say, for example, that when the account owner passed away, you inherit the account and you're 55 years old, then you would look on the table, find the corresponding factor, which let's just say you had to use the one for someone age 55, that'd be 31.6. So that's the factor that you'd use for that first year distribution. And then the following year, you would then subtract 1 from that number, 31.6, and you're dividing the prior year-end balance by that number. And that's telling you how much of a required minimum distribution that you have to take out. So the key is that if you fall within that period where the original owner died after their original beginning date for distribution, so let's say they passed away this year, then next year you would have to start taking out distributions from the account, and you would then use the prior year-end balance divided by your factor, find out on the single life expectancy table, and every year thereafter you reduce that number by 1. And then by the end of the 10th year after the owner's death, you would have to have fully liquidated that account. So again, they pass away in 2024. By the end of 2034, you have to fully liquidate that account. Now, you can take out more than the required amount that you're required to take out, but if you take out less, there's going to be a penalty. So that penalty is 25%, but if you didn't realize you needed to do this and you make it up, then it goes down to 10%. So let's just say that you have an account, an IRA that you inherited a couple of years ago. Maybe they passed away in 2020. And again, there was a lot of confusion about this. People were thinking, well, it's a 10-year window, so I don't need to take anything out of that account until the end of the 10th year. But we now know that's not the case. Well, luckily, the IRS has issued a couple notices, both in 2022, 2023, and even in 2024, saying that there is no penalty if you didn't satisfy these distributions in those years. Because again, we were under the wrong assumption. We didn't realize that, you were supposed to be taking out money from the account. However, you do need to start taking out money next year in 2025. And so that again will be, did the owner pass away after the required beginning date? If they did, then again, you have to start taking out money to satisfy withdrawing it by the end of that 10th year. And the other thing to think about is that even though you don't need to start until next year, should you actually start taking out the money now? Well, really that depends on your income. If your income is lower this year than you think it'll be next year, it might be a good idea to take even more out of the account, especially if you can pay tax at a lower rate. Definitely thinking about taxes and doing some tax planning is an important part of making decisions about when to take money out of retirement accounts, especially inherited retirement accounts, and how that plays into your income. So doing some projections and looking at your income for this year versus next year, figuring out how much you might be able to take out. Are you going to be in the same tax bracket? Are you going to be in a higher tax bracket, a lower tax bracket? These are all things you really should be thinking about when you're deciding when to take out distributions. Beginning next year, if you're in the camp where you inherited an IRA from a non-spouse who passed away after the required beginning date, you're going to have to take out money beginning next year. But it might help you to take out some money this year. So rather than just waiting until next year, you might want to think about doing it this year, or at least looking at to see whether it makes a difference. And just remember, again, by the end of the 10th year after the original owner's death, you have to take the money out. And if they passed away before their required beginning date, you can wait until the end of the 10th year. But really, does that make sense? Do you want to wait that long? Should you just take it all out at once? Should you take it out sooner? Again, the tax planning is an important part of this, deciding when to take this money out. There's another thing also to keep in mind. Anytime you inherit an IRA from a non-spouse, when that person passed away after the required beginning date, is that even though they've passed away, they still actually have to satisfy the required minimum distribution for their year of death. So let's just say they were 73 this year, they passed away, and they hadn't taken out any money out of their retirement account. Well, you would need to make sure you take that money out. you're supposed to technically take it out by the end of the year to satisfy that distribution. Now, it's not your account, so you can't immediately just call up wherever it's being held, the financial institution, and ask them, hey, please satisfy mom or dad's RMD. They're not going to do that. The money first has to be moved over into a beneficiary IRA, and you have to then be able to satisfy the distribution. So there might not be the ability for you to get this all done by the end of the tax year, but it still needs to be done. So the IRS has not changed that. That still is the same. But what's changing is that if your parent had multiple beneficiaries on your account, let's say it was you and one of your siblings, and it makes sense maybe for one of you to take the distribution and not the other because maybe one of you is in a lower tax bracket, you can decide to do that. So you can split it up proportionally if that's what you want to do, as long as you satisfy what mom or dad, or if it's a parent, a friend, family member, whoever it is, make sure that you satisfy that RMD so that you're not subject to that penalty. So again, clarification here is that if you inherited an IRA from a non-spousal beneficiary and that person was past their age or required beginning date, you're going to have to satisfy distributions going forward starting in next year, but you might want to start sooner. So I hope you found this episode and video helpful, and feel free to check out some of my other videos on inherited IRAs. And if you like this video, please click the subscribe button below. And if you're listening, if you're not subscribed to my podcast, please do so. And as always, if you have a listener question that you want to have considered for a future episode, you can head over to retirewithryan.com and click on Ask a Question. Have a great week, and I look forward to talking to you next Wednesday. Take care.